Super, Ashley. Thanks so much for having me today, everyone. I appreciate all the folks in the Together for Choice community joining us. Hopefully I can make this hour a useful hour in your life. I'm going to go ahead and switch my screen over so you can see the presentation, and hopefully if technology allows, we'll be seeing the same materials together here. All right, so it's important to understand where we're all starting from. All of us want the best for our loved ones with special needs. And in this introductory slide, you see a picture of me and my younger brother on my 6th birthday. And this will help you understand that I truly am a member of the special needs community. So on my 6th birthday, you'll notice that I got a Snoopy doll for my birthday, but so did my brother. And he's the one in the foreground of the picture. So growing up with a loved one who had developmental disabilities and was later diagnosed with autism was a life I wouldn't trade for anything. But as in many families, my brother was typically the focus of the planning and the needs and really the attention of my parents, which was fine. I understood that. I appreciate that. And I still love my brother to this day. But my birthday, we both get Snoopies. My picture for my birthday, he's the one in focus. But what you can tell from this picture is I was probably predestined to be a special needs financial advisor, because while he is sitting in the box in our kitchen, I'm outside the box, much like we have to think outside the box for our friends and clients to make sure they get through all the difficult navigational steps it takes in the journey for our loved ones with special needs. So a little bit about me, as Ashley said, 50 years with a brother with special needs, diagnosed at age 32 with autism. Founded the firm 15 years ago because there was no one I could find doing what we do, which is providing independent and objective advice to families like yours and mine who have loved ones with special needs. It was really important to me that people not be sold products or services, but rather are given information to make good decisions. So the whole focus of today's presentation will be exactly that. We're not pitching anything. We're simply trying to educate you more about special needs trust, ABLE accounts, and how to optimize their use for your family situation. We're honored to be the 2023 NAPFA Excellence in DEI Award winner because of our focus on the special needs community and trying to get that to be a more inclusive part of the financial planning population. And I was the first member admitted to the Academy of Special Needs Planners, which is a group of specialists, mostly attorneys, who work with families like ours with the planning needs they have. So I'm going to start this slide presentation with really a point about person-first language. It's really important to us we not offend anyone. I know with the large audience we have today, I'm going to offend everybody at some point with the language I use. And I want to apologize for that up front. Some people don't like the word disability. Some people don't like the word special needs. And some people want to actually have a diagnosis in front of their loved one instead of after. But typically in large presentations, we want to use what's called person-first language. So we'll say the loved one with Down syndrome, as opposed to the autistic child. Now, in some cases, if we're working one-on-one with someone, if they're proud of their diagnosis and want to have that be more prominent in their description, that's fine. We'll do that and we'll honor that. But for today's purposes, I'll try to use person-first or people-first language whenever I'm speaking. But just know that I'm not meaning to offend anyone. The word disabilities come more into use in the community, whereas special needs was kind of the overwhelming term for the prior decade or so. But it seems like now disability is becoming more commonly accepted again. So things cycle back and forth with the language. I think we all need to be aware of that as we move forward as a community. So I know you guys have already talked about public benefits in prior sessions with Together for Choice. I just want to highlight a couple of slides here to make sure we're all on the same page moving forward, because much of the discussion about the benefits of trust and ABLE accounts reflect back on trying to get and keep the public benefits that are available if we qualify and remain qualified for those benefits. So as I think most of you know, your children receive the benefits and services they need through the school system until they turn age 21 or 22, depending on what state you're in. Then the difficult time of transition occurs when we move from the school supports to what we can get from the government or what the family can provide or what the community can provide. So it's really kind of that networking process of getting all the pieces in place when school no longer provides it. And it's not easy to qualify for these benefits. For some of those of you who have tried, the failure rate's actually 2/3 who do not get benefits when they apply the first time. Of that group that fails, roughly half of that group ends up getting them. So somewhere between 50 and 60% of families who apply for benefits for their loved one eventually get them, which is a staggeringly low number in my opinion. I'd love to see that number be much higher, but those numbers we're working with. So we want to make sure that we understand how trust and able accounts can improve our odds for getting those benefits and also keeping those benefits once we have them established. So I mentioned the school age supports. This slide's difficult to read in the presentation, but hopefully if you get the PDF, you can look at it in more detail, because for some of you, there may be a reason to move states. Right now, the minimum age requirement the state has to provide benefits to the school system is age 21. And on that birthday, you graduate and you're done with your school supports. The furthest one out is actually the state of Michigan, which is an outlier. They're the ones in orange, for those of you who are not familiar with the map. But the orange state goes out to age 26 plus, meaning that if the child turns 26 during the school year, they get services throughout the rest of that school year. So they would graduate after their 26th birthday when the rest of the senior class graduates that summer. So those are the ages you're looking at. For almost everybody, it's either 21 plus, meaning the year in which you turn 21, you finish the school year, or 22 or 22 plus. Those would be the purple, green, and blue colored states. So without taking the entire presentation to reiterate what you guys probably already know about benefits, we have one slide here that summarizes the key points. On the bottom half of the slide, we have what are called the means tested benefits. Those are available for our loved ones who have no income or earn a meager income and are considered poor by the government. And those two benefits are an income benefit known as Supplemental Security Income, or SSI, and that can be as much as $914 plus potentially an amount that your state supplements. And then Medicaid, which would be the insurance program and benefits programs that are also provided through the state. So what we want to do is make sure that as our loved ones turn 18, if they haven't worked, they don't have significant assets, we get them registered with the government to receive these benefits. If a diagnosis comes later in life, and maybe they've already earned some income, or maybe they're working and they can't work anymore, well, then SSDI, Social Security Disability Income, becomes the income option. And actually, for any of us, if we become disabled later in life and prior to turning age 62, when we start receiving our Social Security benefits, we can get SSDI, which is effectively taking your Social Security benefit early. What's interesting is, with our loved ones with special needs, if a parent is retired and starts receiving their retirement benefits, the child that's previously qualified for SSI and Medicaid can actually move up and get additional income through receiving a portion of their parents' SSDI benefit, and they can also get Medicare insurance in addition to Medicaid. Because as you may or may not be aware, those two insurance policy programs both provide lots of medical benefits, but in some cases, they're different benefits. Medicaid can help provide for long-term care. Medicare does not provide for long-term care. So when we think about our lifetime of needs for our loved one on the healthcare side, having both of those insurance programs available is a wonderful benefit to provide them with. And obviously, if you have private health insurance under the Affordable Care Act, we're able to keep our loved one on a private health insurance plan really for as long as you're employed and have access to that plan. So the health insurance is much better than it was a decade ago in terms of what our loved ones can get, but it's important to understand the difficulty of getting and keeping these benefits. So use that slide as a reference about what the details are. Don't want to spend a lot of time on that today, but those are the things we're trying to get and keep for our loved one by using the trust and able accounts most effectively. So what's exempt? When we go and apply for benefits, the government's going to say, well, what kinds of assets does the person have? What they're specifically looking for is, what do they have in their accounts? Savings accounts, checking accounts, maybe savings bonds that somebody bought for them on an early birthday or when they were born and set aside, and their Social Security number. The government knows about those things. We want to make sure that we know as well before we apply for benefits, because the government can find more than $2,000 in various accounts that have your loved one's Social Security number on them. They're going to be unable to get these means tested benefits, the SSI and Medicaid. They can own a home. As you guys know, Together for Choice, there's a lot of discussion about housing. Owning a home outright for someone with a profound disability is usually not a good choice. There's lots of home maintenance things, decisions to be made, upkeep, insurance, et cetera, liabilities that come with owning a home. Typically, we want to see the home owned by a trust or by some other third party, although the home would not disqualify you from getting benefits regardless of its value. In addition, having stuff in a house, those assets that are physically there, don't disqualify you, nor does having a car. You can have one car per person. So that child with a disability can have a car. Again, for liability reasons, you want to think about whether you want that car in their name outright or having a trust where someone else owned the car and they have access to it. Those are all separate decisions and discussions to have with your own advisory team. And then in very small amounts, they could also own some life insurance, burial funds, those kinds of things. But those are typically very, very small value items. So effectively, it's $2,000 a house and a car is what they can own. So for planning purposes, we really want to think of it as being zero, because getting to that $2,000 number can happen very quickly. And then if the government notices that the balances at the end of the month exceed $2,000, they will suspend benefits until that gets corrected. And oftentimes families don't understand why the benefits were taken away, and they end up losing benefits for multiple months when they try to understand the challenge and then fix it. So the key there is try to keep all assets out of the name and social security number of your loved one with a disability. So how do we get that done? What are the key elements to make sure that we protect and keep access and eligibility for benefits? Well, the first one's going to be the special needs trust. Okay, it should be drafted by someone who's an expert in this area of law. We don't want someone who did your home closing, who's a real estate attorney, pulling off documents from a shelf or online to create a document for you and your family. You're going to end up with a bad result. The important thing is these trusts, they can own as much in terms of assets as your family can put into them. There's no limit. So these trusts can be a huge support mechanism for our loved ones as they get older. It may be everything they need if it's fully funded at a high number level. Nobody knows what that number needs to be. And I would caution you, if you're talking to an advisor and they try to pitch you on buying a $2 million insurance policy or a $500,000 insurance policy because they think that's the number you need. Well, that would be the number they need to convince you to buy a policy, but everybody's needs will be different. And it's really impossible to nail down a number. What you want to do is figure out what are your resources and then do the best you can to make sure those resources go to where you want them to go, which is having them move from your name or other relatives' names into trust and able accounts that keep your loved one eligible. The other thing that's important across all the special needs trusts we'll discuss today is that the distributions, the money coming out of the trust, is at the sole discretion of the trustee. That language must be in the trust document. The beneficiary has no right to request or demand money coming out for some purpose. They can ask for it, and certainly they should, but that trustee has to have the sole ability to make the decision. So there can't be any automatic rights to income or to maintain a certain lifestyle. That language can't be in there. That's important to understand. And then the last thing is, this is the naming we want for retirement accounts or insurance policies. We want to have the beneficiary be the trust. Okay, so those are the key elements about trust. I want to get into more detail about why trusts are important and what makes them a good trust versus a bad trust and the different types of trusts. So the primary trust that we think about when we talk amongst our colleagues about special needs trusts, also known as supplemental needs trusts, are trusts that are funded by relatives, by parents, by grandparents, by others within the family, even possibly, siblings in some cases are funding special needs trusts for their loved one with special needs. The key here is that these trusts have no payback requirements. Look at the last bullet point. In a trust funded by anybody other than the individual, when the individual passes away, if there's assets remaining in the trust, they can be distributed out to other relatives, to charities, to whomever the family wants as they structure their trust. So during the lifetime, it's for the benefit of the individual. Okay. At death, it can go anywhere you want it to go. There's no government payback. I'll explain why that's a differentiating factor in just a minute. So a third-party trust funded by anybody other than the individual can be any amount of money. These assets do not count towards that $2,000 limit. And the assets need to be spent for that person who is named as the beneficiary. Okay. Well, how is that different? Well, there's also something called a first party or a self-funded or a payback trust. And I'll apologize. In the special needs community, we tend to have lots of names for the same thing, which leads to confusion. But a self-funded or payback trust is what it sounds like on the self-funded part. It's money that the individual had in their own name that they put into the trust. Well, why would you do that? Well, let's say that maybe you were very lucky and your loved one had $20,000 in savings bonds that was given to him or her when they were born. And that's not what the value is. Maybe it was less than that initially, but now at age 18 or 19, when you go and apply for benefits, there's a $20,000 asset there. Well, your choices are, if you want to get benefits, either A, spend that money down on that person. You can't give it to other relatives or give it back to mom and dad. It's got to be spent on them, and you got to show the records of how that money was spent, because government will see that, hey, a month before you applied for benefits, they had $20,000. Where'd that go? You have to show the receipts. So it's got to be spent for them, or it can be put into an ABLE account, subject to the limits we'll talk about. But $20,000 is more than you can fund into an ABLE account a year. So the self-funded trust could be the solution. The money going into a self-funded trust makes you eligible the next day for benefits. It's like you never had those assets in your name, because the assets in a self-funded payback trust have to be spent for the individual's benefit. So it meets that qualification. And as you'll notice at the bottom of this slide, if there's money remaining in that self-funded trust, the trust funded by the person's own assets, if the individual received Medicaid benefits, health insurance, Medicaid programs with value, then the government has a right to claim the remaining assets in the trust up to the value of those Medicaid benefits received during their lifetime. So that's a major difference. Typically, the third-party trust funded by other people's money is the big one. That's what's going to have the primary assets. The self-funded trust will be only for oops type situations, which are too big to put into an ABLE account. But the other rules are pretty similar. The individual can ask for distributions, but can't demand them. The limits are infinite. You can put as much money here as you want. So if the individual happened to play the lottery and won and had a 7-figure windfall, they can put the entire thing into a payback trust and keep attending the Medicaid programs they find beneficial. So that's a way to make sure that no matter where the money is amongst the individual and the family, that they can get access to and retain their public benefits by using a self-funded trust. But for obvious reasons, if we have both the self-funded trust with the person's own money and a payback requirement, and a third-party trust with no payback requirement, we want to spend this trust down first to zero before we use the third-party funded trust. There's no requirement to spend them pro rata or to spend this one first. We want to spend this one first to get it down to zero. So there's no payback when the person dies. And when they die, they only have money in the third-party trust. That would be ideal planning.
Excuse me, Mike.
Yes.
Is there a distinction as to what you can spend the money on, whether it's a third party or a first party?
So in a moment, thank you for that question. In a moment, we'll talk about what are distributions that'll be no problem versus distributions that'll cause the individual to receive less money from the government. But the rules are essentially the same in terms of a trust and what it can pay for versus an ABLE account and what it can pay for. So we'll get to those details in the coming slides. But I like that question because it is important that the trustee knows what is going to be a permissible distribution versus one that causes a loss of some benefits. But there's one other kind of trust I want to hit on very quickly because it's going to apply to a portion of the group on this call today. And that is what's called a pooled trust. Okay, it's a type of self-funded trust. It could also be third-party money. But in some cases, when the parents pass away, maybe there's only $20,000 or $50,000 of assets or total value they're giving to their loved one with disabilities when they're gone. Well, that size account isn't going to be big enough to have a professional trustee and investment manager handling it because their fees and expenses will wipe out the trust very quickly. But a pooled trust has similar rules to the self-funded trust we just talked about. But what it does, it takes lots of smaller accounts and literally pools them or brings them together for management purposes. So instead of having a whole bunch of $50,000 accounts, you end up with a large $5 million account with lots of people who are individual beneficiaries of that larger account. And the pooled trust companies use accounting software to figure out how much money each person's entitled to take out based on what money they contributed in when they funded their share of the pooled trust. Typically, it's going to be funded by a parent through their estate documents, but it can be funded or really created by anybody, even a legal guardian. If the parents died without any estate plans and the courts determine that this loved one they left behind has special needs, they might direct the assets into a pooled trust. We've seen that happen. And in many states, it's required that the person has to be under the age of 65. So if we've got long-lived parents and their loved one happens to be 66 and lives in one of those states, the pooled trust is not an option. We'll talk about what you do in that situation as well. But in this case, we want to utilize the pooled trust as best we can with smaller amounts of assets.
Mike, I'm a little confused. Through your estate planning, why would you go into a pooled trust instead of just putting it into the third-party supplemental needs trust?
Great, thank you for that question. So in most cases, we want to have assets going to the third-party trust. That's correct. The pooled trust is going to be used primarily when it's a really small amount of money, right? The last bullet point on that slide. So if the odds are that the person's not going to have 6 figures of wealth to transfer to the next generation, there's no house to pass on, the retirement account assets are expected to be spent down, you're not expecting much of anything to transfer to the next generation. Well, in that case, you might want to direct it to a pooled trust because then whatever the assets are will receive professional management and have a professional trustee in place, whereas that might not be affordable on a much smaller asset level. So it's really just for smaller amounts of assets that we use a pooled trust, but it works similar to a self-settled trust that if the person then passes away, the person with disability, the beneficiary, passes away having owned a share of the pooled trust, their share of that pooled trust goes either to Medicaid to repay them or back to the pooled trust itself to be spread among the other beneficiaries. So when you're using a pooled trust in that situation, there are no other relatives who will ever benefit from those dollars.
Okay, so Mike, can I pause you for a second? For those of you who have questions, please type that into the chat box. Randy is a co-facilitator of this webinar, and she's the one that is reading the questions and asking questions directly to Mike. So it would be easier for us to communicate if you could just type in your questions in the chat box, and Randy will handle that and manage the Q&A session. Thank you so much. Go ahead, Mike.
Thanks, Ashley. That's a good point too. Randy is my cohort here, has been with me for over a decade, and she is absolutely wonderful at managing all the other non-financial aspects of our family's lives with all the special needs planning considerations. So many times you can put a question in the chat, she'll answer it even without interrupting me at all. She can take care of it quickly for us. So she's a great resource to have. And we'll talk more about a project she's working on at the end of our presentation you might want to participate with. But for now, we'll move on to trustee responsibilities. Oftentimes, we'll have families come to us and tell us that, oh, I'm naming my brother as the co-trustee or the trustee when my wife and I pass away for our child who's 30 years younger, who has Down syndrome. Well, the obvious problem in my head with that is the person you're naming as successor trustee is likely going to die about the same time you do, unless you die really prematurely. So what we want to think about is who's an appropriate trustee to name. So by looking at the responsibilities, it'll help you figure out if there's someone in your family who has all these skills, then maybe you would name a relative. That could be a way to save some money in the planning process. But in many cases, you're going to need to plan to have a professional trustee because a person's got to not just be good at communication with the beneficiary, but also managing the investment assets, right? Making sure that those assets are used to their best level, thinking about risk and having enough cash available to pay the expenses of the individual. Also, filing all the statements with the state and filing tax returns. So there's administrative responsibilities that go along with it as well. And then just staying current on special needs laws, because every year the government puts out new pronouncements about what's allowable and disallowable within the special needs community as far as what trusts can pay for, what becomes what's called in-kind support and maintenance that causes a loss of benefits. We'll get to that in a minute. But it's important that the trustee be on top of those things because if they're not, that creates risk for the beneficiary. So in most cases, we'd like to see a professional trustee in place. And full disclosure, we never can serve as trustees. There's no benefit to us of naming a professional trustee. It actually makes it harder for us in planning with our clients because it's one more expense they've got to factor into their budgeting for their loved one's future. But we also think that having a professional trustee avoids a lot of downstream problems and allows the siblings, who are often named as successor trustees, to remain siblings. And in fact, I had a call with the client yesterday, or actually, no, it was Tuesday. And the individual happened to be in her mid-30s, relatively self-sufficient, and was really worried about having her brother or sister become a trustee of her trust because she thought that then she'd lose that sibling relationship because the trustee would be in charge of her or in charge of her money and have to tell her, no, she can't have the money, which is true. There are times when trustees have to say no to distributions. And so if you can remain a sibling and play a vital role in the family going forward, that's a great thing to do. And have a professional trustee in place to do all the things that a trustee has to do. And there's a role that can be played called a trust protector, where a sibling can have the responsibility to hire and fire the trustee. So if there's a bad corporate trustee not doing their job well, not being a good communicator and finding out what the needs are, well, then replace them. And by having a trust protector in the trust document, that person doesn't have to do all these trust things. They just hire and fire the corporate trustee, which means that trustee stays accountable to the family for the long term. We like that concept because it gives some downstream control to, banks being acquired. We've seen that happen a lot in our industry where big banks acquire smaller banks, and that neat little trust operation you had signed up for is no longer part of big banks' plans. So having a trust protector allows a new trustee to put in place when necessary.
Excuse me, Mike.
Yep.
Couple of questions. The first is, do third-party trusts have to be reported to Social Security and or medical assistance? And if yes, how does one go about doing this?
Okay. So I'll reframe the question a little bit. So when we apply for benefits with our loved one, when they apply for benefits themselves sometimes, the government will ask, what assets do you have? You have to disclose to them, I've got a checking account or a savings account, or I've got some investments somewhere. Hopefully it's less than $2,000, because if it is, you should really get benefits. They will often ask, do you have a trust? And then you have to give them that trust. And we'll talk about ways we want the trust to be drafted in a minute. We want it to be a standalone document, and you give them that document, they review it. And the key element there is, if it has those things we talked about earlier, that the trustee has sole discretion for distributions, there's no ability for the beneficiary to get access to the funds without going through the trustee and having them make a decision. If it's a self-settled trust, the payback provisions must be written into the trust. If the government reviews that and says, okay, yep, that trust qualifies, it's a non-countable resource, no matter how many assets are in there, you're fine. You don't have to give them an account statement about how much money is there. In fact, you shouldn't. You should just give them the trust document itself, because sometimes you'll get a Social Security rep who doesn't really know what they're looking at. They might be newer and not trained as well. And they'll see an account statement with $200,000 in it, say, oh, well, that's over the $2,000 limit. This is disqualified. And forget about the fact that if the trust is properly written, it could have an infinite amount of money in it and not disqualify the family. So all we want to give the government when we're reporting on what the assets are, and if there's a trust, is the trust document itself.
One more question.
Yes.
For tax purposes, is a qualified disability trust also referred to as a third-party trust?
So naming of documents can be anything. So typically a qualified disability trust will be a third-party special needs trust. And depending on how that trust is drafted, many times during a parent's lifetime, the trust is created so that the parents pay the income tax consequences of the trust. So the trust gets taxed like an entity. Right? So if it makes money during the year, if the assets grow, it pays tax like you and I would if we have an investment account. It pays the trust tax level. But it can be structured so that the parents during their lifetime pay that tax. So it's another gift effectively from the parents to the individual by paying the tax responsibility. When the parents die, that third-party trust becomes its own taxable entity, and the trust has to pay its own taxes, which are actually at higher rates or quicker thresholds to get to the higher tax rates than just for individuals and joint couples. So with good planning, we want the people who contribute to the trust, typically the parents, to be the ones paying the tax responsibility until they pass away, at which point it becomes irrevocable and the trust pays its own taxes. And there's some ability, if the trust makes distributions out to the individual, that it can pass out the income tax consequences to the individual as well, at which point the individual pays at their tax rate, which is typically 0 or a very small percent. So there is some tax planning to be done with that. It's important to work with your advisory team to make sure that it gets structured the way that's most beneficial to your family. Okay, we move on to what are permissible and challenging distributions. Somebody asked this question, it's a great one. The name Supplemental Needs Trust became popular because the idea is this trust is meant to supplement what the government provides. The government's providing 3 things by law: shelter, healthcare, and food. The shelter is paid for with that SSI income amount every month, which is $914 this year. Okay? That gets indexed for inflation. So next year, we're probably looking at something close to $1,000 a month. But for 2023, That's going to be $914. Healthcare, that's the Medicaid services piece. And then the food, that's going to be through the Supplemental Nutrition Assistance Program, or SNAP, which used to be called food stamps, which roughly a fourth of the population is receiving currently. So with those things being government provided as means tested benefits, a special needs trust should not be paying for those things if you want to receive the full income benefit. So if you want to retain the full $914 a month, then the kinds of things that the supplemental needs trust can pay for, whether it's a third party or a first party trust, are dental care, optical care, and supplemental nursing care. What you don't see there is primary health care, basic medications, and hospital visits. Those are supposed to be covered through Medicaid. But there's lots of things you can pay for. You can pay for travel, recreational things, technology, and even the expenses related to a family member taking that trip, vacation, whatever, with the loved one who is the beneficiary of the trust. Now, the rules are as follows. If the person has profound disabilities and needs 24/7 care, you can actually have two people have their expenses paid for out of the trust in addition to the individual themselves. If it's less profound, they're relatively self-sufficient but need some supervision, then it's one person. So it's really up to the family to do the right thing there. But those are the expenses that come out of the trust, no problem, full benefits. Now, contrast that with what else could be paid for out of the trust that would be deemed in-kind support and maintenance. So this law is in the process of being changed, but groceries, if you pay for basic food, used to disqualify you up to the amount you spent. So if you spent $200 on food at the grocery store for your loved one, their $914 becomes $714. So when you use the SNAP card to pay for groceries, although the government's in the process of removing that as one of the things they calculate and look for records for. Part of the reason is it's too much of a pain for them to try to track that, right? It's administratively burdensome for the government to look at all of your food receipts and figure out what share of that is your loved one with a disability. But basic medical care, hospital expenses, if you pay for those things directly, you're going to lose up to a third of your benefits. Okay, you're still going to get, roughly $600, but you lose a third. Housing, that's a big one. Remember, the SSI payment is supposed to cover your housing. Well, I don't know how many places you can live for less than $900 a month and be comfortable that your child's safe and happy. But if you can, great. For most of us, it's not going to work. And so if we pay for, out of the trust, housing expenses and all the basic things such as either rent or a mortgage payment or utilities, the basic utilities you'd think of, then we're going to lose up to 1/3 of the benefits. We won't lose all of them, but that check goes from $914 down to $609. And in many cases, that's a good decision. Let's say we've got hundreds of thousands of dollars in the special needs trust and we're getting SSI benefits. Fine. I'd rather keep getting $600 a month for my loved one and use the trust to pay for the additional costs of their housing and have them in a nice, safe place than say, okay, I've got to find a place that I can pay for at a minimal amount, or they stay at home. And a lot of families do this, right? 80% of our loved ones with disabilities live at home with the parents. If you go that route, you can have the child pay the parents rent. The rent amount should be north of that $300 disallowance amount. Because if you show that they're paying rent for, let's say, $350 or $400 a month, then arguably they shouldn't lose the 1/3 benefit because they're spending it on housing. And the parents could then gift that money back to them. That would be the circular calculation, which the government doesn't have a problem with, even though it's kind of silly. So again, on that one, if the child lives at home, charge them rent, they keep getting their full $914 a month, and the parents who collect that rental income can then gift it back to the child into an ABLE account or even to a third-party trust they wanted to fund it early. And those are options to get the money back to the child while they receive the full amount from the government. If there's no rental agreement, then the government deems that to be what's called in-kind support and maintenance, free housing. If you're going to provide the free housing, the government figures, why should we pay for it? We're going to give you the $609, not the $914 a month. Okay. The question often comes up, well, if I'm collecting rental income from my child, isn't that taxable to me? That's not a great answer. Well, the solution to that is, while you have rental income from your child paying you to live at home, you also have rental expenses related to that space in the house. You designate that it's their bedroom, maybe a bathroom, and a share of the common areas. And so you can then prorate your overall household expenses, mortgage, taxes, utilities. My guess is going to be more than the $300 or $400 rent you're charging, in which case your net rental income for the year is a loss. You either put that on your tax return, show a loss, and don't actually deduct it anywhere, or you just don't bother reporting it, saying, I've got the expenses to cover the income. If anybody wants to challenge this, to waste the government's time because my expenses exceed my income. Okay. I'm not going to give you tax advice on what to do, but that's a way to keep the maximum benefit while your loved one lives at home. Okay. So to kind of summarize in special needs trusts, they truly are the cornerstone of the planning because they can take any amount of money the family wants to leave to their loved one and allow them to supplement what the government provides. And in some cases, we have families who have a lot of wealth and they figure, well, I'm just going to pay for everything out of pocket. I don't want to take money from the government that can be used for other families who need it more than we do. We're not going to get the benefits. We would challenge that and say that you don't know what your loved one's going to need in the future. If there's a great Medicaid service in your state that they might want to access later in life, if they're not qualified and haven't started receiving benefits, they're never going to be able to access that program. You can't buy your way into a Medicaid program. So remaining eligible is really important throughout life to make sure that no matter what those future expenses are, the government can help provide some of those needs in the future and the trust and supplement that. Also important to understand that this happens to our clients frequently. If they go spend $3,000 or $5,000 with a great attorney that we help them find, they get this big book of documents and they stop because they're exhausted. Well, the documents are great, but if you don't retitle accounts, if you don't change beneficiaries, which we'll talk about in more detail coming up, the trust doesn't do anything, right? It's just a piece of paper. So we want to actually create the usage of the trust by opening accounts appropriately when we're going to fund them, and then changing beneficiaries to target those distributions from life insurance, from retirement accounts, from whatever it is that you own, you want to have go to your loved one, you want to name the trust as the beneficiary. And then always make sure that every 3 to 5 years, you're checking in with your law firm you work with to see if there's things that have changed in the special needs planning laws that would impact your trust document. And until the parents pass away, and typically it becomes irrevocable, change the trust, right? Make it reflect what the current laws are to get the maximum benefits for your loved one. So how do you find a good attorney? As I mentioned, we don't want you going to the attorney who did your home closing for your real estate. Probably not the best way to get this done. At the end of the day, if the attorney is experienced in this area and has drafted documents and their clients received SSI and Medicaid benefits, the means tested benefits, you can trust those documents are going to work. That's really the litmus test. The government's reviewed the documents and the client's receiving benefits. That's what you want to hear. How do you find the attorneys? Well, you all are tuning in from all over the country today. We know a lot of attorneys in Illinois. Our colleagues in our other offices around the country are familiar with the attorneys in their states. A great way to find an attorney who's an expert in the area is to go to one of these two websites. The Academy of Special Needs Planners has hundreds of attorneys. The Special Needs Alliance has a smaller group, but these are all really qualified attorneys who specialize in this area. And to the extent they don't know a specific answer to a detailed question you're asking, they collaborate with each other. It's a wonderful community of people helping each other. So specialneedsanswers.com, specialneedsalliance.org. If you define an attorney, go to those sites and then just kind of peruse the attorneys and find one that kind of fits your personality and get the documents done. So coordinating. I mentioned that the documents themselves don't do anything. Well, they really don't. What's important here is that you communicate with the rest of the family what you've done. It's really unfortunate when you draft a third-party trust and you're planning for all of your and your relatives' monies. They're going to go to your loved one with disabilities to go to that trust. And you forget to tell them that. And then all of a sudden, sweet grandma Susie leaves $100,000 to your child outright. Well, once that's done and she's dead, there's not much you can do to change the direction of that gift. Now it's going to go into the self-settled trust, and there's a risk of giving that to the government if the person doesn't spin it down during their lifetime. Simple communication, which oftentimes the attorneys can help you with some language to talk about at Thanksgiving or other family get-togethers, to let the relatives know, hey, we spent a bunch of money doing this planning to get the structure right. If you're thinking about leaving assets to our son or daughter, please use the name of their special needs trust. And here's how to name it in your documents. So whether that's a retirement account or life insurance or just other things passing through their estate, name the trust as the beneficiary outright. And it's also important to go and look. We've had clients tell us, oh yeah, I talked to my insurance company. We changed the beneficiary from being John to being John's special needs trust. We say, great, but thinking back to the Cold War era, trust but verify. We want to actually have the client give us written documentation back from the retirement account plan or from the life insurance company, showing who they have on record as the beneficiary. Because when mom and dad are gone, they can't really argue, well, we sent the paperwork in, why didn't you update the documents? Well, let's look and see what the documents say. And we can all sleep better at night knowing that the company made the change in their records, because when the person dies, that's where the money's going to go. You can't change it after the fact. We want to make sure that wherever possible, we're going to name the trust, that third party trust, as the primary beneficiary. And the last note on here, standalone trust. What does that mean? Well, you can have trust documents done different ways. Our preference is that the special needs trust be its own single document, not be part of mom and dad's bigger trust document that says when mom and dad die, upon their death, create the special needs trust for their son or daughter. A couple reasons for that. One, what if grandma dies before mom and dad and wants to leave money to that child? Well, mom and dad haven't died. That special needs trust doesn't come into existence until mom and dad die. So she can't leave it to the trust. That's a problem. Further, we talked about how the government wants to see that trust language to make sure that when there's assets in there, they're not going to be able to count those as available resources. So we want to make sure that when we're giving the government our estate planning information, we give them as little as possible. They're only entitled to see the special needs trust. But if the special needs trust is a sub-trust of a bigger estate planning document, like a will or a trust for mom and dad, well, then they get to see the whole thing. And there might be some language in there that, the family would rather keep private. It might be that they feel that the way that's structured, it's going to be a disqualified trust, and therefore all the assets are going to count. We want to give the government as little as possible, as required, to review. So I'm just give them that one single document. Okay, hopefully that makes sense. We want a standalone document. I just went through that ad nauseum, so you have a slide that says everything I just said. But the key thing there is we don't want the trust to be drafted as a sub-trust of a will or a parent's trust. How are we going to fund it? Well, that's a question that's impossible for us to answer to a community of 100 plus people watching us today. Each family is going to be different. Life insurance is often an interesting choice because that allows the parents to utilize their own retirement assets down to their last nickel for their last breath and not worry about not having enough to leave to the next generation. We've seen families where everything gets pushed to a special needs trust or into other accounts for their loved one with disabilities. And there's nothing for the parents. The parents are going to retire in their late 60s or whatever their plan is. Like, what are they going to live on? They'll have Social Security, but for most people, Social Security is not going to be enough to meet their lifestyle needs. So we want to allow the parents to benefit from their own retirement accounts as fully as possible, but then also have something left over for their loved one's trust. Oftentimes it could be the house, right? That can be liquidated and the value of the house can fund the trust, but oftentimes it's insurance. And it's an important distinction to understand here about life insurance. When we're buying life insurance, there's two main kinds of policies, one of which is a term policy and one of which is what's called a permanent policy, which often is whole life or universal life or variable life or has really glossy lipstick names they put on it to make it look more attractive. A term policy has that name because the term for which it'll cover and pay benefits typically ends when the policyholder is 65 or 70, and typically never later than age 70. And the idea is that's to pay for lost wages. So while they're working, if that breadwinner can no longer bring home, their income, the insurance policy can pay out and give assets to the family they can live on in lieu of the money that the person was earning. But unless a parent wants to guarantee they'll die before they're 65 or 70, that's not going to provide any money for a special needs trust because that policy goes away. So we're looking at a permanent policy, which will be more expensive to fund the trust. That way we know there'll be assets there and a way to possibly reduce the cost of that permanent policy is to do what's called second to die insurance, meaning that the policy will only pay out at the death of a second person. So if we've got a married couple, we'll say, okay, we'll make those two the lives we'll put the policy under. And when the second parent dies, then the insurance policy pays out to the trust. With the thought being, as long as one parent's alive, they'll do everything they can to take care of their loved one. If it's a single family situation where a single parent's involved, we can name that parent's sibling, someone else, could be really any other person, right? Typically, we want a healthy person. And when the second of those two people die, that's when the insurance pays out. So those are things to think about in terms of funding the trust. You don't need to fund the trust day one. Some states require a $10 or $20 minimum initial contribution fine. Take a $10 bill, put it in a yellow manila envelope, call that the funding and set it aside. Do not go out and open up an account at a bank or somewhere else to hold a $20 bill. So any questions on trust before I move over to able accounts?
Hold on one sec, Mike, sorry. Does a third-party special needs trust have to be testamentary? What if you want it to exist before parents or the funders die?
Great question. Our preference is for it not to be testamentary because we want to have that trust be available to be funded when anybody wants to leave a decent sized contribution to create the base of that account. So if it's testamentary, that typically means that the person has to die before that trust gets created. So that's really not optimal because we don't know who's going to die first. If someone's on their deathbed, I don't mind it being testamentary. But in most cases, that's not the planning we're seeing. We're seeing families come in and they've got a young loved one. They're planning for their future. They don't know what the assets are going to be. They don't know who the relatives might be that contributes. By having a standalone document that's not dependent on someone dying, that's a much better solution. And as I just mentioned, we want that to be a standalone document with a specific name that can be given to other relatives to use as the beneficiary of their estate plan to the extent they want to help that child with a disability. Okay, let's go to able accounts. Able accounts are a little bit easier to understand. They're also super easy to open. You have to go online. You can't go to your financial advisor. You can't go to a bank. The family itself, and there's an order of operations, but basically it's the individual, a parent, a guardian, and it's a pretty small group of people who are legally allowed to open an able account. But you do it online. It's tax-free. So it works like a Roth IRA account. It's going to grow and accumulate tax-free. As long as it's spent appropriately for that individual's needs, it comes out tax-free. So it's really a tax-free forever type account. It was created because families said, hey, a couple of our children are working. They've got retirement plan accounts, they've got IRA accounts. They can save for their future in a tax-free vehicle. That's great. Our other child is unable to work. But if we can get money into their name, why can't they save tax-free as well? Well, the government solved that in 2014, and the first accounts became available in 2016, so that they have a tax-free savings account. These things are ideal to have as part of anybody's plan, even if there's no money currently to be put into an able account. The reason for that is they solve for those surprise gifts. Maybe there's a special birthday, a holiday, and they get $500 or $1,000. And all of a sudden, that little savings account you set up to hold those amounts is over $2,000 at the end of the month. That's going to jeopardize benefits. So we want to use an able account to take those little amounts of money and shelter them, because this is also not an account that gets looked at in terms of being an available asset for our loved one disabilities. Like a trust, able accounts are not countable resources. But there are limits. We'll get into those details. And if you're in one of the 40 states that has a Medicaid payback, it's similar to a self-settled trust. You may have to pay money back to the government if your loved one received Medicaid services and has an able account balance at death. So let's go through these relatively quickly and what the basics are. The most you can fund into an able account in a year is $17,000. That number is indexed. I will guess that it'll be $18,000 next year, but currently it's $17,000 from all sources. So the person can only have one account, but anybody can fund it. The person themselves, other relatives, anybody can fund it up to a cap of $17,000 of total contributions per year. If the person's working, they can also include their earnings up to about another $13,500. So in theory, if you're working, have an able account, you can go to $30,000 a year of contributions. You can also roll over money. Let's say you had set aside money in a 529 plan, and a little bit later in life, you realize, well, they might not be going to college. So all that money we set aside, the $20,000, $50,000 we have there, we're not going to be spending it on college. Well, you could move up to $17,000 a year from a college 529 plan to fund the ABLE account and then use it for a much broader type of thing than just higher education. You can use an ABLE account for that as well, but you're not limited to only using it for education. And the maximum account size differs by state. We'll get to some of the other limits, but if your child's not receiving means tested benefits, they didn't qualify because they make too much money or they just failed all the tests because they had assets here and there and they couldn't get that stuff moved around in time. Well, then the limit for the ABLE account becomes anywhere from $350,000 to $520,000. So it can be a huge way to save tax deferred for our loved ones. What are the basics? Well, the diagnosis of the disability must happen before age 26. There's a law in the books right now that says starting in 2026, that number goes from age 26 to age 46, which is a wonderful benefit for many of our military veterans who come back with different disabilities from serving the country, but had that happen to them after they're 26 years old. They can't use an ABLE account currently. Starting in 2026, they'll be able to, because that age for diagnosis moves up from 26 to 46. You don't have to be getting SSI or SSDI to open an account. Although if you are, as you go through the application process, you simply check the box. Yes, I'm receiving these government benefits, so I can automatically open the account. Otherwise, you have to attest that you've got qualifying disability and you've got medical records to support it. You don't have to send those documents in, but you have to attest that you have them. Okay. Also, I mentioned that you can put earnings into the account as well above the $17,000 amount if the person's working. That's true if the person's not contributing to their company's retirement plan. They can't double dip. This is really meant as a replacement for those kinds of retirement plans. So if they are using a 401k or a 403b plan, they can't also fund their ABLE account with their earnings. Only that initial $17,000 amount can be used. So the benefits, tax-free, up to $100,000 will not jeopardize those means tested benefits, the SSI and Medicaid. Above 100 grand, it starts to become a countable resource. So we've got some clients who've been using these things for years. We want them to start spending it down. And typically you'll leave a portion of the ABLE account in cash to pay for expenses, and the bulk of it will be in an investment to grow for the future. And one of the key things on this slide, which we'll get to in more detail in a minute, is that the expenses are broadly defined. Whereas we have those certain kinds of expenses out of a trust that are considered to be in-kind support and maintenance, and will cause us to lose a third of our benefits. Not so for the ABLE account. It can pay for almost anything and not jeopardize benefits. And unlike a trust, where the individual can't demand the money out for what they want, an ABLE account is in their control. It's their social security number. They're the boss. If they want to use it to buy candy bars, they can use it to buy candy bars. So as a parent, you've got to decide, okay, if my child's going to have access to the money in the ABLE account, has free reign over spending it, can they make good decisions? How much do I want to really tell them about the ABLE account, how easy it is to use it? That's up to you as a family to figure out. But the individual has full rights and access through check writing or a debit card to spend the money out of the account. What are the limitations? We talked about the dollar limitations for funding. The $100,000 is the cap if you're getting the SSI and Medicaid benefits. You must have had your disability before age 26. And there aren't very many investment options. Whereas a trust can invest in almost anything. An ABLE account has anywhere from 5 to 7 investment choices, which are basically aggressive, moderate, conservative. And then the plan picks the underlying investments for you. You're not making a lot of investment decisions with an ABLE account. And as I mentioned earlier, there's a payback requirement similar to that payback or self-settled trust if there's assets in an ABLE account and the person received Medicaid services. So how are they similar to trusts? Well, they're exempt in calculating the available resources for an individual, up to a $100,000 limit for an ABLE account. Assets are protected from creditors, so there's some safety there, although the person could be taken advantage of and someone could convince them to spend the money inappropriately. But as long as it's in the account, it's safe from creditors. They can't be sued and lose that money. It can be distributed to support the individual. That's really the key purpose for both trust and ABLE accounts, is having a place to hold money to support our loved ones. And I mentioned the payback, it's similar to the self-funded trust. So what's different? Well, with a trust, you can have $1 bazillion and have no issues. The ABLE account, either $100,000 if we're getting means tested benefits, or up to the state limit for a 529 plan, which is between $350,000 and $560,000, depending on the state plan you choose. You can customize your trust a little bit. The ABLE account, you're simply clicking on some buttons, open the account, and that's what you get. There's no personalization or customization available. Nice thing about ABLE accounts, there's no cost to set it up. You don't go to an attorney. And in fact, an attorney, financial planner cannot open the ABLE account for you. You have to go online, or in fact, your loved one should go online and do that with you. Okay. Nice thing at the bottom there, no tax return required. Once the trust has taxable income, it has to file a tax return, even if it has no tax liability. ABLE accounts, under current law, there's no tax reporting at all. It's a tax-free account. States don't require reporting, nor does the IRS. So what are qualified expenses? Pretty much anything. So health, broadly defined. You can pay for any kind of healthcare expense. Housing, education, transportation. You can read the list. Basically, anything for the individual's benefit is a qualified expense. What's unique here is, let's say we have a trust that has hundreds of thousands of dollars. One of the jokes in our industry is that ABLE accounts are legal money laundering. So for any government officials who are listening, yes, you know this too. You can take money in a trust, distribute it to the ABLE account, and pay for housing expenses and not incur a decrease in benefits through in-kind support and maintenance. The trust can push $17,000 into the ABLE account. The ABLE account can then pay for things like utilities, which if the trust paid for it, we're going to lose a portion of the income benefit. But if the ABLE account pays for it, as it says here, housing, that's broadly defined. It can pay for anything related to housing. So we like using ABLE accounts because it gives us flexibility. Small gifts that show up go in the ABLE account and they get spent. If we need to pay for certain expenses that a trust is going to lose some of those means tested benefits for the person if they pay for them directly, housing, food, those kinds of things, let the ABLE account pay for it. So how do you pick a good ABLE account? Well, one of your handouts is our comparison matrix. The government also does something similar on their website, which is ABLE-NRC for nationalresourcecenter.org. Ours actually lists all 40 plus states side by side. On the government site, you can compare 3 side by side. There are currently only 6 states that do not require that a balance in the ABLE account be paid to the government when the person dies. The other roughly 40 states, if there's a balance there, the government gets it. And so look at that, find what's most important to you. There are 18 states that if you're a resident of that state and you make a contribution to the ABLE account, you get a state income tax deduction. So there are some different factors to consider when you're picking a plan. The expenses are relatively similar. In many cases, picking your home state, especially if there's a tax deduction available for making a contribution, ends up being the best choice for the family. But use that matrix and make a good decision for your family. Beneficiaries, real quickly here, it's important that we name the special needs trust as the beneficiary on life insurance policies and retirement accounts. Why? People think their will controls everything. It doesn't. The will tells where money is supposed to go if it's not already predetermined. And if an account has a beneficiary designation on it, like a life insurance policy does, like retirement accounts do, that's where the money goes. It overrides what the will might say. So I want to make sure that that's where we designate the beneficiaries to be the trust. Okay. Communication, I'll get this real quickly. Tell everybody in your circle what you're doing with your planning. If they understand there's a trust there and that's where the assets are supposed to go, hopefully they point them there as well. If you don't tell them, they're not going to know. Okay. These are quick things we've kind of covered. It's a summary there. You can go back and review these later. But we want to make sure that assets go to the trust at the parent's death, not to the individual. We want to use permanent type life insurance, not term insurance, to fund a trust. We're going to use insurance at all. We're going to draft the trust as a standalone trust now, not as a testamentary trust that only comes into existence at the parent's death. We want to review all beneficiary designations to make sure that we got the trust named, not the individual. Broad communication is important. And then utilize all the planning you're learning about through Together for Choice, through the other resources you have, and build a great community to learn about what the options are and what's most appropriate for your family. So with that, I'll open up to questions, but I'll say one last thing, that you can reach out to us. We're actually in the process of writing a book called It's Okay to Laugh. The idea is that all of us have challenges in our lives with our loved ones with disabilities. There's often some really funny circumstances. We're in the process of trying to collect 200 funny anecdotal stories from all the families we come across. We're going to compile those. We'll take the names of the families out to protect the innocent, but we want to let people know that, you know what, in our community, really funny stuff happens. It's okay to laugh about that. And if you're having a bad day, you're able to open the book, find a funny story, laugh about it, and go to bed happy, as opposed to going to bed frustrated about what happened during the day. And if you contribute a story to us, you get a free book. So that's our offer to you. If you want to reach out to us and share a funny story, you get the book. We'll expect to publish that later this year. We'd love to get contributions for the book as well. But with that, I'll open up to other questions for the few minutes we have left.